Welcome to the deep dive. Today, we're going to be tackling a big challenge, one that impacts every single one of us, really.
Yeah.
How to finance the transition to low-emission food systems. We're talking about making the way we produce and consume food, much more sustainable. And it's a massive undertaking, right?
It is.
Luckily, we've got a great roadmap from Wageningen University in research.
Oh, yeah, I've seen this one.
They've examined 6 different financial instruments.
Yeah.
That could be the key to unlocking a greener future for food.
What's fascinating here is that we're not just talking about tweaking a few things, right?
Yeah.
It's about completely transforming a system. I mean, a system that's been in place for centuries.
Wow.
Think about it. Every bite of food that you take
Okay.
is connected to this complex web of farmers, processors, distributors, retailers. I mean, every step in that journey has an environmental impact.
So how do we revamp this entire system in a way that's good for the planet and makes financial sense?
It's a big question.
That's what this report really dives into. Now, full disclosure, this report is dense.
Oh, yeah.
We're going to break down the most important parts and, dare I say, make it fun.
Yeah.
Make it interesting.
Absolutely. And this isn't just for, the financial whizzes out there.
Right.
Whether you're a policy wonk, a foodie, or just someone who cares about where their food comes from. This deep dive has something for you.
Okay, let's start with the elephant in the room.
Okay.
The sheer amount of money needed to make this transition happen. This report doesn't sugarcoat it.
Right.
We're talking about a massive influx of capital to get these low-emission food systems up and running.
Think about it. We need to invest in cutting-edge technology.
Right.
We need to support farmers in adopting climate-smart practices.
Absolutely.
We need to make sure our food supply chains can weather the storms, both literally and figuratively.
Wow.
I mean, it's a global undertaking. It won't be cheap.
And here's the kicker. Convincing investors to back all of this is no walk in the park.
Oh, no.
It's like trying to convince someone to invest in a time machine. The potential is huge, but the risks seem pretty scary too, right?
The report highlights a few key hurdles.
Okay.
One is the perceived risk.
Right.
Investors are naturally cautious, and sustainable food systems are still seen as relatively uncharted territory, especially in developing countries.
Right.
There's always that fear. Political instability, unpredictable weather patterns, new technologies not working as planned. Then there are the upfront costs. Let's say a farmer wants to switch to renewable energy, like solar panels, to power their irrigation system, or adopt more, eco-friendly farming practices.
Yeah.
These changes require significant initial investment, which would be a major deterrent, right, for a lot of people.
And let's not forget about the millions of smallholder farmers who are essential to global food production.
Right. They often lack access to traditional banking and financial services, making it even tougher to invest in sustainable practices.
Yeah.
Reaching these farmers effectively and inclusively is crucial if we want to see real change.
So how do we address these challenges and unlock the financial floodgates for low-emission food systems? That's where these 6 financial instruments come in. Each one has its own quirks and advantages.
Right.
And we're going to explore them in detail.
First up, we have green finance.
Okay.
This is essentially your classic financial world, but with an eco-conscious twist.
Okay.
Think green bonds,
Right.
which are specifically used to fund environmentally friendly projects, or ESG screened funds. ESG stands for Environmental, Social, and Governance Criteria, where investors choose funds that align with their sustainability values.
And here's a real eye-opener from the report. In Colombia, the demand for green bonds was a whopping 3 times higher than the supply.
Really?
That tells you something. Investors are increasingly seeing the potential and the profit in sustainable food systems.
Interesting.
If you're looking for investment opportunities that align with your values, this is a trend to watch.
Absolutely. While green finance holds immense promise, it tends to favor larger corporations or projects.
Okay.
So how do we level the playing field and make sure these investments reach smaller players, like those smallholder farmers we talked about?
Yeah.
That's where blended finance comes into play.
Blended finance is all about teamwork, bringing together public and private capital to share the risk and make those investments more appealing.
Right.
It's like that friend who convinces you to try that new spicy dish by saying, "Don't worry, I'll share it with you."
Right.
It's less scary when you've got backup.
Less risk.
Less risk.
The report showcases a fantastic example of blended finance in action. A waste-to-energy plant in Vietnam was struggling to get funding.
Okay.
Investors were hesitant because of the perceived risks associated with a new technology in a developing country.
Right.
By blending public funds with private investments, they managed to secure the necessary capital.
Interesting.
And get the project off the ground.
It's a testament to the power of collaboration and risk sharing. Now let's talk about an instrument that's been making waves.
Yeah.
Carbon credits.
Okay.
This is where things get really interesting because it directly connects environmental action with financial rewards.
Essentially, carbon credits are a way to put a price on reducing greenhouse gas emissions or removing carbon dioxide from the atmosphere.
Wow.
Companies or individuals can buy these credits to offset their own emissions. It's like a balancing act.
Yeah.
If you emit a certain amount of carbon, you invest in projects that reduce or remove an equivalent amount somewhere else.
And this can directly benefit farmers.
Right.
Imagine a farmer who adopts practices that improve soil health and trap carbon in the ground. They can potentially earn carbon credits for those efforts, creating a new revenue stream while also benefiting the environment.
The report delves into the intricacies of carbon markets, which can be quite complex.
Right.
There are compliance markets, where companies are legally required to offset their emissions, and voluntary markets, where individuals or organizations choose to offset their carbon footprint out of a sense of responsibility.
But here's the big question.
Okay.
Can carbon farming, where farmers are paid for their carbon sequestering practices, become a reliable source of income?
It's a big question.
Especially for those smallholder farmers. We're talking about potentially transforming the lives of millions of people while also fighting climate change.
It's a fascinating prospect, but it's not a simple solution.
Right.
We need to make sure these carbon markets are transparent, fair, and actually deliver on their environmental promises.
Right.
There's a risk of greenwashing, where companies or projects claim to be more sustainable than they really are just to cash in on the carbon credit craze.
So there's a lot to unpack when it comes to carbon credits.
Right.
We'll delve deeper into this in the next part of our deep dive. But for now, let's move on to another instrument that focuses on the interconnectedness of nature and finance. Payments for Ecosystem Services, or PES.
PES is all about recognizing and rewarding the crucial services that nature provides, like clean water, biodiversity, and carbon storage.
Okay.
It's based on the idea that if we benefit from these services, we should be willing to pay for them.
It's like paying rent to Mother Nature for all the amazing things she does for us. And this can have a huge impact on farmers in rural communities.
Right.
Imagine a community that relies on a nearby forest for clean water.
Okay.
They could create a PE scheme where downstream water users like cities or businesses pay the community to protect and manage the forest, ensuring a clean water supply for everyone.
The report highlights a fantastic example of PES in action in Kenya. A community-led mangrove conservation project is generating income by selling carbon credits based on the carbon stored in these vital coastal ecosystems.
Okay.
The funds are then used to support local development projects like education and healthcare. It's a win-win, protecting nature while also empowering communities.
This is a prime example of how these instruments can work together to create a positive ripple effect. We're talking about protecting valuable ecosystems, combating climate change, and improving the livelihoods of local communities, all at the same time.
Absolutely. Now, let's shift gears to an instrument that might seem a bit less glamorous, but can be incredibly powerful. Tax incentives.
Taxes. Not exactly the most thrilling topic. But stay with us, because this is where governments can really step up and steer the ship towards sustainability.
Think of tax incentives as a way to nudge businesses and individuals towards making eco-friendly choices. For example, a government could offer tax breaks for companies that invest in renewable energy, or for farmers who adopt sustainable farming practices.
Like a little bonus for doing the right thing for the planet. But here's a critical question. Can tax incentives actually drive meaningful change in our food systems?
Right.
Or will they simply create loopholes for corporations to exploit while doing little to help those who need it most, like smallholder farmers?
It's a debate worth having.
It is.
The report explores this very question, emphasizing the importance of designing tax incentives in a way that is both environmentally effective and socially equitable.
Okay.
We need to ensure that they benefit everyone, not just the wealthy and powerful.
That's a key point. Okay, let's wrap up this part of our deep dive with our final instrument.
Okay.
Repurposing agricultural subsidies.
That's a big one.
This was a biggie because it's about taking existing financial flows and redirecting them towards a more sustainable future.
Agricultural subsidies are a massive industry globally, but unfortunately, they've often been used to support practices that are harmful to the environment, like intensive farming that relies heavily on chemical fertilizers and pesticides.
It's like giving someone money to dig a hole while simultaneously funding someone else to fill it back in. It just doesn't make sense.
Exactly. But what if we could take those subsidies and use them to encourage farmers to adopt practices that are good for the planet?
Yeah.
That's the idea behind repurposing.
The report actually points to China as a leader in this area.
Okay.
They've been gradually shifting their agricultural subsidies away from production-based incentives,
Right.
where farmers are essentially rewarded for producing more, regardless of the environmental impact,
Yeah.
toward payments for ecosystem services, which we discussed earlier.
It's a significant shift in mindset.
It is.
And it's a signal that even major agricultural producers are starting to recognize the need for a more sustainable approach.
This is just the tip of the iceberg when it comes to repurposing agricultural subsidies. We'll explore this further in the next part of our deep dive, where we'll look at some real-world examples and the challenges and opportunities associated with each instrument.
Stay tuned, because we're about to take a deep dive into the nitty-gritty of financing a greener future for food.
Yeah.
Welcome back to the deep dive. Are you ready to, roll up our sleeves and get into the details of how these financial instruments can actually be put into practice?
I am. In the last part, we laid the groundwork, talked about the challenges, and introduced the 6 instruments.
Right.
Now I'm excited to see how they're playing out in the real world. Where should we start?
Let's stick with green finance for now. We talked about how Colombia saw a huge demand for green bonds, 3 times the supply, to be exact.
Yeah.
That's a clear signal that investors are hungry for these opportunities, and it just shows how quickly things are changing.
That's exciting. But I have to admit, the term green bond still sounds a bit abstract to me. What kind of projects are we actually talking about?
Well, for example, in Colombia, they're using green bonds to finance renewable energy projects, like solar and wind farms.
Okay.
This helps reduce reliance on fossil fuels, which is a major driver of climate change.
Okay, so it's not just about funding vague green initiatives. It's about tangible projects that directly address environmental issues.
Exactly, and they're also using these bonds to support sustainable transportation, like electric buses and bike-sharing programs. This not only reduces emissions, but also improves air quality and makes cities more livable.
I see. So these green bonds are funding solutions that have a direct impact on people's daily lives.
Absolutely. And to make sure these investments are truly green, Colombia is developing a green taxonomy.
Okay.
This essentially means they're creating a clear set of rules and guidelines to define what qualifies as a green investment.
So it's like a stamp of approval saying, hey, this project meets our rigorous standards for environmental sustainability. That helps investors make informed decisions and avoids greenwashing, which we talked about earlier.
Precisely. It ensures transparency and accountability. Now let's hop over to Kenya. They've got a green bond program coordinated by the Kenya Bankers Association and the Nairobi Securities Exchange.
So they're creating a dedicated platform to channel investments towards green projects. That's a smart move.
It is, and their focus is broad, encompassing everything from sustainable infrastructure like water and sanitation systems to social inclusion projects, like affordable housing and education initiatives.
It's a holistic approach, recognizing that environmental sustainability is intertwined with social and economic development.
Yeah.
You can't really have one without the others.
Well said. Now let's zoom over to China. They're taking a slightly different approach to green finance, focusing more broadly on environmental benefits rather than solely on climate change mitigation.
So their definition of green is a bit wider. What are some examples of projects they're funding?
Well, they're investing heavily in things like pollution control, water conservation, and biodiversity protection.
Okay.
For example, they might fund projects to restore degraded ecosystems, improve air quality in cities, or promote sustainable agriculture practices that reduce water pollution.
It's like they're tackling multiple environmental challenges simultaneously.
Exactly. And they're also placing a strong emphasis on financial inclusion, ensuring that smaller businesses and farmers have access to these green financing opportunities.
That's essential. We can't just have a green economy for the wealthy and powerful.
Yeah.
Everyone needs to be a part of this transition.
Agreed. Now remember, blended finance, our teamwork approach to unlocking bigger and bolder investments.
Yeah, the public and private sectors joining forces to share the risk and make those tougher investments a bit more palatable. Like that time I convinced my friend to go skydiving with me. I knew he wouldn't jump alone, but with a buddy, he was all in.
Exactly. Well, the report highlights a really compelling example of this in Colombia. They're using blended finance to tackle deforestation in the Amazon rainforest.
Now that's a big one. Deforestation is a major contributor to climate change, and the Amazon is one of the most important ecosystems on the planet. How are they using blended finance to address this?
They've developed a program called the Integrated Sustainable Landscape Management for Cattle Ranching Activity, or ITPS for short. It's a mouthful. But essentially, they're providing financial incentives, technical assistance, and market access to ranchers who agree to adopt sustainable practices.
So it's not just about throwing money at the problem. It's about supporting ranchers in making a real long-term shift towards more sustainable practices.
Precisely. And it's working. They've already seen a significant reduction in deforestation rates in the areas where the program is active.
That's encouraging. It shows how blended finance can be a powerful tool for addressing some of the most pressing environmental challenges.
It does. Now, let's shift our focus to Kenya. They're using blended finance to tackle a different but equally important challenge: empowering smallholder farmers.
That's something we talked about earlier. How do we make sure these financial mechanisms actually reach the people who need them most?
Exactly. In Kenya, they've got a program called the Kenya Agricultural Finance Program, or KAFP. It's backed by the International Fund for Agricultural Development, or IFAD, a major player in rural development.
IFAD. They're a big deal in the world of sustainable agriculture.
They are, and through KAFP, they're working with commercial and microfinance banks to help them expand their lending to smallholder farmers.
So it's like they're creating a bridge between the traditional financial world and those who have been traditionally excluded.
Exactly. And it's not just about increasing access to credit. They're also providing farmers with training and support to help them develop business plans, adopt new technologies, and diversify their income streams.
It's a more holistic approach, recognizing that financial inclusion is about more than just loans. It's about empowerment and opportunity.
Well said. Now let's move on to an instrument that has generated both excitement and controversy: carbon credits.
Ah, yes. The instrument that aims to put a price tag on saving the planet. I'm eager to hear more about how it's being used in practice.
Well, let's start with Colombia. They've taken a bold step by implementing a carbon tax. This means companies are required to pay a fee based on their carbon emissions.
So they're literally putting a price on pollution.
Exactly. And to offset their tax liability, companies can invest in certified carbon projects. These are initiatives that demonstrably reduce greenhouse gas emissions or remove carbon dioxide from the atmosphere.
It's like a pay-to-pollute system.
Yeah.
But with the caveat that the money is used to fund activities that actually benefit the environment.
That's a good way to put it. And the report highlights some interesting examples of these carbon projects in Colombia. For instance, there are projects focused on promoting sustainable coffee production, restoring degraded forests, and implementing renewable energy solutions.
So it's not just about companies writing a check to offset their emissions. It's about channeling that money into tangible actions that have a real impact on the ground.
Precisely. And the report emphasizes the importance of robust measurement, reporting, and verification, or MRV, to ensure that these projects are actually delivering the promised carbon reductions.
MRV, that's our accountability check, right? Making sure that the money is being used effectively and that we're actually seeing real environmental benefits.
Exactly. Now, let's shift our focus to Kenya. They're taking a more community-based approach to carbon credits. One standout example is the Mikoko Pamoja project, which focuses on mangrove conservation.
Mangroves? Those incredible trees that grow in saltwater, they're like nature's superheroes, protecting coastlines from erosion, providing habitats for countless species, and storing vast amounts of carbon.
You're absolutely right. The Mikoko Pamoja project works with local communities to conserve and restore mangrove forests, and they generate revenue by selling carbon credits on the voluntary market.
So they're essentially getting paid to protect these vital ecosystems. That's a beautiful model.
It is. And the funds are used to support community development initiatives, such as education, healthcare, and clean water projects.
It's a powerful example of how environmental protection and social development can go hand in hand.
Now let's hop over to Vietnam, where they're still in the early stages of developing their carbon market,
Okay.
but are making some exciting progress.
What's catching your eye there?
One project that stood out is a collaboration between the International Rice Research Institute, or IRI,
Correct.
and the German Development Agency, GIZ.
IRI. They're the race experts, right? What are they up to in Vietnam?
Well, rice farming is a major source of methane, a potent greenhouse gas. This project is exploring ways to reduce methane emissions from rice cultivation and create a framework for rice farmers to access carbon markets.
So they're essentially paving the way for rice farmers to get paid for reducing their environmental impact. That's a big deal because rice is a staple food for billions of people around the world.
It is. If they can crack the code on reducing methane emissions from rice farming, it could have a significant global impact.
This is incredibly promising. But I'm also curious about the potential downsides of carbon markets.
Yeah.
Earlier, we talked about the risk of greenwashing. Are there any other concerns we should be aware of?
There are. One concern is that carbon markets could create perverse incentives.
Okay.
For example, if the price of carbon credits becomes too high,
Yeah.
it might incentivize companies to simply buy credits.
Instead of actually reducing their own emissions.
So it's like a get-out-of-jail-free card for polluters.
That's a risk we need to be mindful of. It's important to ensure that carbon markets are designed in a way that incentivizes real emissions reductions and avoids simply shifting pollution from one place to another.
That makes sense. We need to hold everyone accountable and make sure these markets are truly driving the change we need.
Agreed. Now let's move on to payments for ecosystem services, or PES, our instrument that recognizes and rewards the valuable services nature provides.
I love the idea of paying rent to Mother Nature. It seems like a much more harmonious way to interact with the natural world.
It is. And there are some really inspiring PES projects happening around the world. In Colombia, they've implemented a PE scheme in the Chena micro watershed.
A micro watershed.
Essentially, it's a small area of land that drains into a common waterway, and this particular micro watershed provides water for several communities downstream.
So they're paying people upstream to manage the land in a way that protects the water quality downstream. Exactly. They're compensating landowners for the opportunity costs of conservation. This means they're recognizing that landowners could be using their land for other activities like intensive agriculture.
Right.
That might generate more income in the short term, but could harm the environment in the long run.
So they're essentially paying people to not do something that would be harmful. It's like an insurance policy for the environment.
That's a good analogy. And the Chena project has been quite successful. They've seen improvements in water quality, increased biodiversity, and enhanced community engagement.
That's fantastic. It sounds like peace can be a really effective way to protect valuable ecosystems while also supporting local livelihoods.
It can. And remember the Mikoko Pamoja project in Kenya, which we discussed in the context of carbon credits? Well, they're also using PS.
Wait, they're double dipping, using both carbon credits and PS.
They are. It's a really clever approach. The income generated from carbon credits helps fund the PS scheme, creating a sustainable financing model.
That's brilliant.
Yeah.
They're leveraging multiple financial instruments to maximize their impact.
Now let's take a look at Vietnam. They're implementing the Carbon and Biodiversity Program, or CARBI, in the Quang Nam and Thua Thien Hue provinces.
CARBI sounds intriguing. What's their focus?
CARBI is all about incentivizing sustainable forest management. Hydroelectric companies, which rely on healthy forests to regulate water flow, are paying a fee to a government-managed fund.
Okay.
This money is then distributed to local communities who are contracted to protect and manage the surrounding forests.
It's like a win-win-win situation.
Yeah.
The hydroelectric companies get a reliable water supply, the communities benefit financially, and the forests are protected.
Exactly. It's a great example of how P can create mutually beneficial partnerships between different stakeholders.
This is really eye-opening. It seems like PCS has the potential to be a game changer for conservation and sustainable development.
It does, but like any financial instrument, it also has its challenges.
I'm sure. What are some of the hurdles they're facing?
One key challenge is ensuring that the payments are high enough to incentivize sustainable behavior while also being affordable for the beneficiaries.
Right.
It's about finding that sweet spot where the economics work for everyone involved.
Makes sense. You don't want to create a system where people are forced to choose between protecting the environment and putting food on the table.
Right. And another challenge is ensuring that the benefits of PE are equitably distributed so that everyone in the community benefits, not just a select few.
That's a crucial point.
Yeah.
We need to be mindful of power dynamics and ensure that these financial mechanisms don't exacerbate existing inequalities.
Absolutely. Now, let's move on to an instrument that might not have the same allure as carbon markets or PES, but is equally important: tax incentives.
Because I know. Not the most exciting topic, but they play a vital role in shaping our world. How are they being used to promote sustainable food systems?
Well, we already talked about Colombia's carbon tax, which allows companies to offset their tax liability by investing in certified carbon projects. But Colombia is also using tax incentives to encourage green investments in other sectors, like renewable energy and sustainable transportation.
So they're creating a more favorable environment for businesses that are working towards a greener future.
Exactly. And they're not alone. Kenya is also exploring ways to use tax incentives to promote sustainable practices. For example, they're considering tax breaks for companies that invest in renewable energy projects or for farmers who adopt water-efficient irrigation techniques.
It's like giving a little financial nudge in the right direction.
It is. But as with any policy tool, there are potential downsides to tax incentives.
I'd imagine.
Yeah.
What are some of the things we need to be careful about?
One concern is that tax incentives can be regressive, meaning they disproportionately benefit wealthier individuals and corporations.
Okay.
We need to make sure they're designed in a way that promotes equity and doesn't widen the gap between the rich and the poor.
Right. We don't want to create a system where the wealthy get tax breaks for buying electric cars, while lower-income families are struggling to put food on the table.
Exactly. And another concern is that tax incentives can reduce government revenue, which could impact funding for essential services like healthcare, education, and social welfare.
So it's a balancing act, finding ways to promote sustainable practices without undermining the government's ability to fund important social programs.
Exactly. Now let's wrap up this part of our deep dive with our final instrument: repurposing agricultural subsidies.
This is where we take those massive financial flows that are currently propping up unsustainable practices and redirect them towards a greener future.
Precisely. We talked about China earlier and how they're leading the way in shifting agricultural subsidies towards payments for ecosystem services.
It's like they're saying, hey farmers, instead of just paying you to grow more, we're going to pay you to be stewards of the land.
Exactly, and they're not alone. Kenya has implemented the Smart Subsidy program, designed to be more market-friendly and environmentally sustainable.
Smart subsidies. I like the sound of that. What makes them so smart?
Well, they're more targeted than traditional subsidy programs.
Okay.
For example, they're using e-vouchers to help farmers purchase inputs like fertilizers and seeds at a subsidized rate.
So they're trying to ensure that the subsidies are actually reaching the intended beneficiaries and being used for their intended purpose.
Exactly. And they're also linking the subsidies to sustainable practices. For example, farmers might need to demonstrate that they're using water-efficient irrigation techniques or reducing their reliance on pesticides to qualify for the subsidy.
It's a clever way to encourage farmers to adopt practices that are good for both their bottom line and the environment.
It is. But repurposing agricultural subsidies is often met with resistance. There are powerful vested interests that benefit from the status quo, and changing the system can be a political minefield.
I can imagine there's a lot at stake, both financially and politically.
There is. But the report makes a compelling case that repurposing agricultural subsidies is essential if we want to create truly sustainable food systems.
It's clear that each of these instruments has its own strengths and weaknesses, but what I'm really curious about is how they can work together to amplify their impact.
That's a great question, and it's something we'll explore in the next part of our deep dive, where we'll synthesize the key takeaways from the report and discuss the bigger picture of financing a greener future for food.
I can't wait. Stay tuned, deep divers. The journey continues.
Welcome back, deep divers. We've journeyed through green bonds, blended finance, carbon credits, PES, tax incentives, and even tackled the behemoth of agricultural subsidies.
It's been a whirlwind tour of financial innovation.
Yeah.
But now comes the crucial part, right?
Right.
How do we put all of this into practice and make these instruments work for a more sustainable food system?
Yeah, you're spot on. The report doesn't just leave us with a toolbox and a pat on the back, right?
Right.
It digs deep into the practical considerations that can make or break these efforts. And one that keeps popping up is accessibility.
Right. It's one thing to have all these fancy financial mechanisms, but if they're out of reach for the people who need them most, what's the point? We've talked a lot about smallholder farmers who are often excluded from traditional financial systems.
Exactly. They might lack collateral, credit history, or the sheer scale to attract larger investments.
Yeah.
So how do we bridge this gap?
Right.
The report offers some intriguing solutions, like promoting cooperatives and farmer organizations.
It makes sense. It's like that old saying, there's strength in numbers. By joining forces, smallholder farmers can pool their resources, share risks, and become more attractive to lenders and investors.
Precisely. Imagine a group of farmers coming together to invest in a shared processing facility or a solar-powered irrigation system.
Yeah.
Suddenly, they're a much more viable proposition for a bank or a green bond issuer.
And there's another benefit to this collaborative approach, right? Cooperatives and farmer organizations can offer training, technical assistance, and even marketing support to their members, helping them adapt to sustainable practices and access new markets.
It's about creating a network of support and empowerment. Now, speaking of access, the report also highlights the potential of digital platforms, what some call, fintech for farmers.
I love that. It's like bringing the power of Silicon Valley to the fields.
These platforms can connect smallholder farmers with lenders, provide financial education, and even facilitate payments and transactions, all through a simple mobile app. Imagine a farmer in a remote village being able to secure a loan, track their finances, and even sell their produce online, all from their phone.
That's incredible. It's like opening up a whole new world of financial possibilities for people who have been traditionally excluded.
It is, but we need to be cautious. Just like with any technology, there are potential downsides. We need to make sure these platforms are secure, transparent, and accessible to those with limited digital literacy. We don't want to create a system that further marginalizes those who are already vulnerable.
That's a crucial point. Technology should be a tool for empowerment, not exclusion. Now, along with accessibility comes the question of affordability.
Yeah.
Even if smallholder farmers can access these financial mechanisms, can they actually afford them?
That's a critical question. The report dives into this affordability challenge head-on. Think about things like certification costs for organic produce,
Right.
or fair trade products. These can be quite hefty, especially for smaller producers.
Right.
And then there are transaction fees, administrative hurdles. All these costs can quickly eat into any potential profit.
It's like taking one step forward and two steps back.
Yeah.
So how do we make these systems more financially inclusive?
The report suggests exploring a range of options. Grant funding, for example, can provide much-needed financial support without the burden of repayment. Concessional loans, which offer lower interest rates and more flexible repayment terms, can also make a big difference.
And what about crowdfunding? I've seen some amazing projects get funded that way, where people from all over the world contribute to support a cause they believe in.
Crowdfunding has huge potential. It allows individuals to directly support sustainable agriculture projects, bypassing traditional financial institutions altogether. It's a way to democratize finance and connect consumers directly with the producer.
I love that. It's like voting with your wallet.
Yeah.
Now, throughout our deep dive, we've encountered the ever-important acronym MRV, Measurement, Reporting, and Verification.
Ah, yes, MRV, the bedrock of accountability. It's one thing to set ambitious goals and invest in sustainable practices,
Right.
but it's another to actually track progress, measure impact, and hold everyone accountable.
Without MRV, it's all just talk, right?
Yeah.
We need to be able to see the tangible results, prove that these instruments are working, and ensure that the money is being used effectively.
Exactly. And this is particularly important for instruments like carbon credits and payments for ecosystem services.
Right.
We need robust systems in place to verify that emissions are actually being reduced, that forests are being protected, and that ecosystems are being restored.
Otherwise, we risk falling into the trap of greenwashing, where companies or projects make grand claims about their environmental performance without any real evidence to back it up.
Precisely. The report stresses the importance of investing in MRV capacity building, especially in developing countries. We need to empower local communities and institutions to collect and manage data effectively, ensuring transparency and accountability.
It's about creating a culture of data-driven decision-making, where we're constantly evaluating, learning, and improving. Now, beyond these practical considerations, the report also highlights some overarching themes that really resonated with me.
I'm with you there. What stood out to you?
Well, one theme that struck me was the importance of collaboration. It's not about picking one instrument over another. It's about finding ways to make them work together. like pieces of a puzzle.
Absolutely. The most successful projects are those that involve a diverse range of stakeholders, each bringing their own expertise and perspective to the table. We need governments setting the policy framework, investors providing the capital, farmers implementing the practices, and civil society organizations holding everyone accountable.
It's like that old African proverb, if you want to go fast, go alone. If you want to go far, go together.
I love that.
This transition to low-emission food systems is a marathon, not a sprint, and we need everyone on board to make it to the finish line.
Well said. Another key theme that resonated with me is the need to shift our focus from simply financing production to financing sustainable consumption.
Yeah, that's an interesting thought. We spent a lot of time talking about how to finance sustainable agriculture. But what about the demand side of the equation? What good is it if we're producing sustainable food if no one is buying it?
Exactly. Consumers have an incredibly powerful role to play in this transition. The report suggests exploring a range of options to encourage sustainable consumption patterns.
Like what? Give me some examples.
Well, labeling schemes, for example, can help consumers make informed choices. Imagine a label that clearly shows the carbon footprint or water usage associated with different food products.
Right.
That would allow people to vote with their wallets and support companies that are making a genuine effort to be more sustainable.
I love that. Transparency is key. What else?
Tax breaks for sustainable products are another option. Governments could reduce taxes on organic produce, plant-based alternatives, or locally sourced foods, making them more affordable and appealing to consumers.
It's about making sustainable choices the easy choice. And what about education and awareness campaigns?
Those are crucial. We need to raise awareness about the environmental and social impacts of our food choices. Imagine a campaign that shows the connection between deforestation and our insatiable appetite for cheap meat, or the impact of food waste on climate change.
It's about connecting the dots for people and helping them understand the bigger picture. If people knew the true costs of their food choices, they might be more inclined to make sustainable decisions.
Exactly. It's all about empowering consumers to become conscious eaters, making choices that are good for their health, their wallets, and the planet.
So we've come a long way in this deep dive. We've explored the challenges, the opportunities, and the incredible potential of financing a greener future for food. But where do we go from here? What's the main takeaway you want our listeners to walk away with?
My main takeaway is this. This transition to low-emission food systems is not a pipe dream. It's a necessity. And it's not just about the environment. It's about our health, our well-being, and the future of humanity.
It's about creating a food system that nourishes both people and the planet.
Exactly. And it's achievable. We have the tools, the knowledge, and the passion to make this happen. It's going to require a collective effort, a shift in mindset, and a willingness to embrace innovation and collaboration.
Well said. This has been an incredibly enlightening journey. But as always, the conversation doesn't end here.
This report is just a starting point. It's up to all of us to continue exploring, innovating, and pushing for change.
So keep learning, keep questioning, and most importantly, keep eating consciously.
And don't forget to check out the show notes for links to the full report and other resources.
Until next time, deep divers, keep on diving.